let's solve another past paper, paper 1 to October-November 2021 session. Let's begin. Before we start, I remind you to hit the subscribe button because more videos will be uploaded. So if you want to stay updated with that, please hit the subscribe button and turn on notifications for more videos. Question number 1, which statement is correct? The accountant prepares the trial balance and the bookkeeper prepares the financial statements. Completely opposite. No. The accountant writes up the journals and bookkeeper writes up the ledger accounts. No such information. You just need to know definitions of accountant and bookkeeper, or accounting and bookkeeping. Accounting prepares financial statements using the bookkeeping records, while bookkeeper prepares the detailed or maintains the detailed transactions on a daily basis. The bookkeeper writes up the journals and the accountant prepares the trial balance. The bookkeeper writes up the ledger accounts and accountant prepares the financial statements by definition. Number 2, which formulas may be used for the accounting equation? Assets equal equity means capital minus liabilities. Wrong. The basic one is asset equals capital plus liabilities, and then there'll be different variations of that. Liabilities equals asset minus owner's equity, which makes sense. So if we move that over there, it's going to be assets minus capital equal liabilities. That makes sense. Liabilities equal asset minus owner's equity. Owner's equity equals asset plus liabilities. If we keep capital on one side and then, no, they're subtracted, not added. Owner's equity plus liabilities equals asset. That's the basic format. So yes, 2 and 4. Number 3. Goods purchased on credit from Zamir were returned by Ashwin. Which entries would Zamir make to record this? For Zamir, this is... Look, you must clarify the relationship. Zamir is the seller and that is the customer. So for Zamir, that's a sales return. And sales return, you should know, are debited. So C. Another way to look at it is Ashwin is the customer. Ashwin is the customer. It's a receivable. And now receivables are falling because we're not going to receive that amount anymore. Ashwin, the receivable goes down. When assets go down, they're credited in the asset account. Number 4. During her first financial year, a trader paid $1,800 for insurance, $3,200 for rent. These are expenses. At the end of the financial year, she transferred insurance of $1,500 and rent of $3,600 to the income statement because that's what belonged to that particular year. What do the balances? It's the first financial year, by the way. What do the balances remaining on the accounts at the end of financial year represent? So she actually paid $1,800, and only $1,500 was related to that year. So that's why they transferred it to the income statement. She transferred it to the income statement. The extra $300 is a prepaid expense, isn't it? It's a prepaid expense because she paid extra $300. And for the rent, she actually only paid $3,200, but the rent for the year, which is transferred to the income statement, is $3,600. So she paid $400 less. And so that's $400 accrued rent, accrued expense for the rent and prepaid for the insurance. Let's move on. Number 5, Leah bought goods 8,000 less 15% trade discount. She later returned half of these goods as they were faulty. Which document did Leah issue to the supplier for the return of goods? So Leah, the customer can never issue a credit note. The customer can only issue a debit note. So debit note is the answer. Are we just going to take half of that, 4,000? No. There's the trade discount. So even when we return, the discount will be taken into consideration. So multiple ways to solve this. One way is first calculate how much she actually bought those goods for. Remove 15%. 8,000 times 15%. 1,200 times 15%. That is 1,200. 1,200 was the discount, trade discount. So 6,800 is what she was invoiced with. Now divide that by 2 because half of that was returned. So that will be 3,400 debit note. Done. Number 6. What is a check counterfoil used for? I saw this question in the previous video as well. You can go watch the previous video. Paper 1 October-November 2021. Check counterfoil is that part on the check which is kept with the one who's paying. So when you make a check, you fill in this information, you give this check away to your supplier or whoever you're making the payment to, And this is the part you keep, and this is known as check counterfoil. This counterfoil is what you keep while making a payment. So this stays in your checkbook. So how will we use it? We will use it to make a credit entry in the bank column of the cash book because it's during the payment, isn't it? So this is similar to the previous question, the one that came in the previous paper, but a little bit different in terms of the answer. Yeah, let's move on. Number 7, Farouk sells goods on credit. A check from Khalid, a credit customer, was dishonored. So this is also a repeated question from the previous variant. When this payment was made, when Khalid made as a payment, from Farouk's perspective, we record it like that. Bank debited, Khalid credited. Because Khalid's making the payment, we're getting money into the bank. But later it was dishonored. This transaction was kind of cancelled, right? So you flip it. You debit Khalid again, because you're going to reverse the effect, and you will credit the bank. And actually, yeah, that's it. That's it. That's the only option. Let's move on. Why does a supplier offer trade discount? To avoid irrecoverableness, that's the cash discount. You would encourage them to pay early with a cash discount so they don't, become irrecoverable. To encourage bulk buying, yes. During the trade discount is allowed at the time of transaction, and it is to encourage bulk buying mainly. In other cases, it's because of old business relations. They may get a trade discount or give a trade discount. To encourage payment in cash, no, you never have to really encourage payment in cash to anyone. They can pay through check if they want. Even cash discount does not mean they're paying in cash. They can pay using check, right? It's about how quickly they pay, not the method of payment. To reward prompt payment, again, this is nothing. Option C means nothing. Option A and D are related to cash discount, and B is about trade discount. Let's move on. Number 9. Anne maintains a petty cash book using the Impress system where every period starts with the fixed amount, which statement is not correct. A petty cash book can be maintained by a junior staff member. This is true. A senior member does not have time for maintaining a little petty cash book, right? That's the whole purpose. Somebody junior can manage it. We give them a fixed amount of money and they manage it. So this is true. This is not correct. That is actually correct. At any time, petty cash vouchers plus the petty cash balance are equal to the impressed amount. What does that mean? That means petty cash vouchers are the business documents used, or they're the proof when somebody has to take any money from the petty cash box, they will have to fill in a voucher. So petty cash voucher is basically all the amounts of money spent during a period, and what we have remaining, well, they should add up to the impressed amount. That is true. That is correct. Are you guys getting me? So let's say the impressed amount is 100 and 70 of that was spent. When you spend that, what is the business document used? That is the vouchers. Okay, so the vouchers are a total of 70 and the remaining balance is 30. And they should add up to the impressed amount, right? The money spent is basically the vouchers, and the money remaining is the remaining money. You add them up, they should add up to the total amount we had. That's true. The chief cashier is not asked continually for small sums of money. Yeah, that is also true. A unique sentence in accounting, but that is true. So the chief cashier is not asked for small sums of money again and again because they're busy with other things. That's again the purpose of maintaining petty cash. Only one option remains. The number of entries in the cash book increases because the large number of small cash payments. Such an obvious choice, isn't it? So your cash book will actually have lower number of transactions rather than greater number of transactions because most of these small transactions are now entered into the petty cash book. That's one of the advantages of petty cash book. It reduces the number of entries in the main cash book. It doesn't increase it. Okay. Number 10. A sales invoice of $800 was incorrectly recorded in the sales journal as 1800. Okay. At first I didn't read that and I thought, well, what's wrong with it? Well, there's nothing wrong so far, but then it was recorded as 1800 instead of 800. That's the problem. How did this error affect the trial balance? Okay, the trial balance balanced, but both totals were overstated by 1000. Now look, when you record an invoice, you sold something to somebody. When you record that invoice as 1800, that's basically an error of original entry. Okay? So in your sales journal, there will be a list of all the transactions. In between, you inserted this 1800, more transactions, and now you see what happens. Your total is overstated by 1800, and your individual entry is also overstated by 1800. You know what? If you made a mistake only in totaling it, that will affect the trial balance. But right now, what you've done is you have affected an individual entry. This will go to an individual account, okay? And also you have affected the total. So this will go to your sales account as 1800, and also go to your trade receivables account as 1800 rather than. So essentially your trial balance will actually be not, it will balance, or it will balance, it will not be unbalanced. And so both totals will be overstated by 1,000. Your sales, which appears on the credit side, will be overstated. Your receivables will be overstated as well, which appears on the debit side. Your debit and credit both are overstated by 1,000. You understand this question? Let's move on to number 11. A standing order, it's when a standing order means you make fixed payments automatically from your bank. When, let's say, you have some uh, internet bill, it's fixed every month. You pay that using standing order, so you don't have to pay that every single time manually. The bank will automatically pay a fixed amount at a fixed interval. Let's say end of the month, $20 every month. The bank will do that for you. That's a standing order. A standing order paid for rent has not been entered into the accounting records of a business because it's paid directly through the bank. Which statement is correct? Because the payment was made automatically, looks good to me so far. No additional entries are, oh, no, that's a problem. We need an additional entry. Although the payment was made, so far it was good, but then it messed up, wrong. Because the payment was made automatically, correct so far. Only an entry in the rent account is required. No, we need to make an entry. Well, it's true so far, but we need to make an entry as well. Entries are required in cash book and in the bank reconciliation, not in the bank reconciliation, because the bank knows about it. In the bank reconciliation statement, we fix things that the bank doesn't know about, like unpresented checks and uncredited amounts. Entries are required in cash book and in the general ledger. That's true. Because you need to make an entry in the cash book as a credit, and you need to make a debit entry in your rent account as well. Because your business doesn't know about that yet. When you look at your bank statement, you realize there was a standing order that was automatically paid. Okay, so don't be distracted by this word automatic. The rest of it does not make sense. Okay, interesting question again. Number 12. This paper looks interesting to me. I advise you to first attempt all the question, then look at the video, please. Watch the video, I mean. The bank statement of a business had a credit balance. Number 11. Number 12. Okay, the bank statement of a the bank statement for business had a credit balance of 2690, and that means a positive balance on 1st October 2021. At that date, checks totaling 850 had not yet been presented for payment. These were supposed to be deducted. These are not yet presented. They were supposed to be subtracted, but they're not done yet. So we have a positive balance of 2690, and we need to remove the 850. Now this is an extremely basic bank reconciliation question. 2690 minus 850, 1840. 1840, and it's still positive. That means just be a bit careful. Look at the question. What was the bank balance in the cash book? Interesting. I was about to go wrong with this one, but then I realized this might be a trick. So 1840 is the debit balance in cash book. If they had asked you about, let's say, the balance in bank statement, that would be a credit balance. You should know that these are opposite. Whatever a debit balance in cash book means a credit balance in bank statements. You all should know that. Let's move on. Number 13. A trader has purchased a new business premises. What are the examples of capital expenditure? Cost of heating and lighting of the new premises, that is a revenue expenditure. It's a day-to-day running expense. Cost of purchasing new premises, that is cost of purchasing a non-current asset. That is true. Legal cost of purchasing, that is a cost associated with the purchase of the premises. Any legal costs, they are added to the capital expenditure. You should know that by definition. Office furniture purchase for use in the new premises. And that is also true. That's the purchase of non-current asset. 2, 3, and 4. Easy option. Number 14. Two companies each purchased motor vehicles 10. Oh, okay, I recognize this from the previous video. You can go back to it and understand the question. The answer I also remember is B, 100 greater for H, but you never know. What if they change some of the details? Well, what happens here is two companies, G and H, they both are depreciating the machines, and for the second year, we need to calculate what's the difference in their depreciation. So for the first year, it's year one, it is 10,000 times 15%, which is 1,000. Let me check. 1,500. And for the year two as well, for G, it's the same thing because it's straight line, 1,500. For H, however, it's 10,000 times 20%. For the first year, it's 2,000. And then for the second year, you take 8,000. You take the net book value, 10,000 minus 2,000, 8,000, and you take 20% of that, which will be 1,600. And so H is greater by 100. Let's move on. Number 15. At the end of the financial year, Mui had prepaid rent of 1,500. How should she record this? Okay, so it's a prepaid rent. It's an expense prepaid. It should be carried down. Carry it down as a debit balance. She should carry it down. The verb carry. She should bring it down, basically carry down or bring down it as a debit balance and credit the 1,500, right? So these are always very confusing. Just be a bit careful with these. What if they had told you and CARRIED, carry it down? That makes it the balance CD thing. And that should be the opposite of debit, Here they're talking about the action of carrying it down, basically brought down. Carry down means brought down, balance brought down. Okay? So we bring it down as a debit balance and we credit 1,500 as a balance CD. This is your balance CD and this is your balance BD. Number 16. After preparing financial statements, draft financial statements at the end of her first year of trading, sometimes this is an important detail, first year, second year, third year, Lucy discovered the two errors. Damaged inventory had been valued at cost price 340. It was expected to sell for 180. Inventory valuation, take the lower of cost or NRV. This is the NRV, take the lower one. So it seems like we should reduce our inventory by how much? By 340 minus 180. Well, 160, our inventory is overvalued by 160. 100 items which had been expected to sell for $12 each had been valued at their cost price of $7 each. Carriage inwards of 1 for each item had not been included in the cost. Okay, so for the closing inventory, you know what? We have taken the cost as $7. You should know that the carriage inward is also counted as part of the cost. So instead of taking it as $7, we were supposed to take it as $8. Well, $7 already taken off its value. We just need to take one more dollar, right? So our closing inventory is actually 100 times 1. That is $100 more. Whatever we have it right now, it's $100 more than that, our closing inventory. Are you guys getting me? Inventory is valued at lower of cost and NRV. In this case, NRV is 12, so it's out of question. And the cost is not just 7, it is the cost itself and any carriage inward, any cost of bringing the goods into its present condition. So 7 plus 1, 8 is the cost. However, 7 is what we took as the value of our inventory. Well, we're missing out on the 1. So we take $1 as well. And so, our inventory is overvalued by 160 and then it's undervalued by 100. So overall, our inventory right now is extra by 160 and wait a minute, let me just read that again. Sorry, I'm getting a bit distracted here. So our inventory is overvalued by 160 and here it's undervalued by 100. So overall, it is overvalued by 60 overvalued. Does that make sense? Hope so. Overvalued, undervalued. The net effect is 60 is overvalued, right? Because 100 cancels the 100, and so 60 is overstated. Yeah, that looks good. A. Number 17. Which is an advantage and a disadvantage of operating as a sole trader? What is advantage? Gains all the profit, gains all the profit. Provides all the capital, that's a disadvantage. Bears all the risk, that is a disadvantage. Disadvantage, advantage. Controls the decision making, that is an advantage actually. Like that is an advantage, not a disadvantage. Let's move on. Number 18. What is shown in the capital and liabilities section of a statement of financial position of a business? In the capital and liabilities section, how the resources are being used by the business, that's not it. The working capital of the business, not at all. Total amounts owed by the business, owed by and to the business, no. To the business, that would be the assets. Where the resources of the business have come from. Whenever somebody explains you the accounting equation, assets equal capital plus liabilities, they should tell you that this is what we have and this is where it's coming from. So capital and liabilities, where the resources come from, the resources that we have, right? Number 19, John maintains a full set of accounting records. John maintains a full set of accounting records. Why does he also prepare a statement of financial position? We saw this question in the last paper as well, paper 1-1, October, November, just the previous one. To calculate profit for the year, we use income statement. To check if assets equal capital plus liabilities, although that happens, that's part of it, but that's not why we prepare statement of financial position. It is although close to the right answer, but there's a better option later. To show the transactions which took place during the year, no. It shows what we have at a particular point, not what happened during the year. To summarize what a business owns and what it owes, and that's one of the definitions of SOFP. It summarizes, it lists the things that business owns and the things that business owes to others. So basically assets and liabilities and capital. Number 20. A sole trader paid off the business's overdraft using his own personal funds. Essentially, he introduced capital. But basically, that's what he did. How did this affect the statement of financial position? Because owner is separate from the business. If owner pays personal funds to repay business overdraft, that is some capital introduced. It's going to increase owner's capital. Owner is investing more money, right? So our liabilities are definitely falling and our capital is definitely increasing. So we've already canceled the two options because we know liabilities are falling and we know capital is increasing. What about the assets? Well, there is no effect on the assets, right? Because it's not like we're getting any money. Do you see any effects on capital? Assets. In the MCQs, students tend to go for the wrong option for no good reason. If you don't have a good reason to think that assets are increasing, just don't blindly go for it. It makes sense to take C, right? So yeah, I'm pretty sure you all have regretted choosing the wrong option later on. Like you knew the right answer, but then you went for the wrong one for no good reason. Don't do that, okay? That's the one tip for MCQs. Make up your mind, choose something, and then if you have made up your mind, why would you just randomly change it before submitting the paper? Don't do that. Number 21. Hassan found that he needed help to run his business. He decided to take a partner rather than employ an assistant. Why did he decide to take a partner? An assistant would not interfere with how the shop was run. Well, that would be a reason to take an assistant. An assistant would not share risk. Yeah, that's why he took partner. Because if he takes assistant will not share risk, but a partner would. A partner will be willing to share the risk. A partner would introduce some additional capital. That's also true. A partner would take share of the profit. Is that the reason to take partner? No, that's not a good reason. Like that's not the reason he must have thought to invite a partner. Like that's not why he chose a partner, because he wants to share his profit. Who would want to do that? So you can simply cancel 1 and 4. You'll get to know that 2 and 3 are the right answers. Number 22. Anwar is a sole trader making annual profit of 24,000. Okay, I already recognized this from the previous paper again. I advise you to go back to that. Don't miss out if your exams are so close. Go through all the videos, in my opinion. So, or at least go through all the papers and then watch the video for the difficult ones. Now, Anwar directly gets from the partnership. Anwar is getting 10,000 salary, and then he's also getting half of the remaining profit, residual profit for distribution. He's getting half of that, which is 20K, and so 20,000. Now, Anwar in total is getting 30,000 from the partnership, and originally he was getting only 24,000 from his sole trader business. So now he's getting 6,000 extra. That's all. I repeat, this was better explained in more detail. If you don't understand any part of it, go back to the previous video. It is explained in more detail. 23, another repeated question. What is equity? Equity is the share capital and the reserves. So that's 500,000. And capital employed is, one of the ways to calculate capital employed is total assets, sorry, non, sorry, I'm just gonna, that's another method. Total assets plus, total assets minus current liabilities, that's one method. The other method, which is possible in this case, is capital or equity plus non-current liabilities. So that is 670. Okay. Number 24, the issued share capital of CD Limited consists of, wait, that's another repeated question. Well, number 24, another repeated question. I remember the option, I think, was 18,500. So what you do with this one is you start with the opening retained earnings, 86,000, and then you add the profit that's given, 26,000. You subtract any transfer to general reserve, 5,000, and you don't know the dividend figure, but we know it's going to be something subtracted, so minus X, and that overall gives you 88,500, the closing retained earnings. Opening retained earnings, closing retained earnings, there's a whole journey. Okay, do some basic algebra. 86,000 plus 26,000 minus 5,000 minus 88,500. That's 18,500. All right, I paused the video for a second there because I got a little cough. Number 25. A sports club was formed on 1st August 2020. During the first year, during the year ended 31st July, the club purchased equipment costing 5,000, paying by check. In which of the club's financial statement did this appear? It's also a repeated question from the previous variant. It will definitely appear in the receipts and payments because we made a payment of 5,000 through the check, and it's a purchase of an asset, non-current asset specifically. So the statement of financial position will be involved. If they were talking about, let's say, depreciation on that, will involve income and expenditure as well. But right now it's not relevant. Number 26. A sports club has 100 members and annual subscription is $60. During the year ended 31st August 2021, some things were happening. Let's see what's the question. What was the total amount received from members during the year ended 31st August? Okay, that can take some time. 12 members paid their outstanding subscriptions from the previous financial year. 10 members paid their subscription in advance for the following financial year. Okay, so what were we supposed to receive in this period? 100 members times 60. That's 100 times 60, that's 6,000. What we were supposed to receive. Like, imagine we've received that. But then they later tell us subscription for the current financial year were still outstanding by 8 members. 8 members did not pay us. Out of the 6,000 which we were supposed to receive, we received everything except for these 8 members. So 8 times 60, because these 8 members did not pay, this is what we received for the current year. They are also telling us that we also received from 12 members outstanding from the previous financial year. So we also received 12 times 60 for the previous year, and we also received 10 times 60 for the next year, right? So I just subtracted the things we didn't receive if we were supposed to, and we added the things which we actually received. So let's simplify this further. 6,000 minus, that's one way to do it. There will be another way. Maybe you make a little T account. You can do it that way if you like. But yeah, we'll do it this way. 8 times 60 is 480. Plus 12 times 60 is 720. Plus 10 times 60 is 600. 6,000 minus 480 plus 720 plus 600, 6840. This is what we received during the year. It is kind of a logical answer. Now you can also attempt this using a T account. Make a subscription account and put this as an opening balance, everybody. Please do that. Put this as an opening balance. It was outstanding. It was outstanding income, means accrued income. You put that as a debit balance brought down. And then you put rest of the information as it is available to you. That is the income statement, transfer 6,000, the amount you received here for the next financial year. You put that as the amount received, and the payment is recorded. So just record everything, and you'll also get to the same conclusion, 6,840. In my opinion, this logical way is much better than making a T account in this case. Normally, I'm a fan of creating T accounts and finding the missing figure, but in this particular case, this is not a bad approach. Number 27. Beth provided the following information. Saw this question in the previous paper. This net assets also means capital. They're the same thing. Net assets means total assets minus total liabilities. Capital means total assets minus total liabilities. This is the magic, the classic magic formula that I made up. You start with the opening capital, 28,000. You add any profit or loss. Well, we'll keep it as X. We don't know if it's profit or it's loss. That will be known once we get the answer. Minus the drawings equals 24,000 in this case. So 28, okay, 24,000 minus 28,000 plus 3,000. That's negative 100. I mean, sorry, negative 1,000. That is loss, okay, because it's negative. Let's move on. Number 28. Roshan's sales. This is also repeated. I don't know why everything is repeated. Roshan's sales for the year, sales for this year, for the first year of trading are 55,000. The gross margin is 20%. You make that margin markup table. Write down the sales, cost of sales, and gross profit, percentage, dollars, and it's 20% of the sales. So 20 out of the 100. Like we'll put sales as 100 in percentage units, and gross profit is 20 of whatever that is. So 55,000 divided by 100 times 20. That's 11,000. And 55 minus 11,000, that's 44,000 cost of sales. Cost of sales is 44,000. So how do we get cost of sales? We do opening inventory, which is not here because it's the first year of trading, plus purchases minus closing inventory gives us 44,000, the cost of sales. Profit in this case is 47,200. Better explained in the previous video. So again, I advise you to go back and watch that one. Which information is required to calculate return on capital employed? You need the profit before interest over the capital employed. Profit before interest is same as operating profit for the year. And how do you calculate capital employed? One of the ways is non-current liabilities plus owner's capital, right? C is the right answer, just based on the formula. That's all. 30. What is the best indicator of liquidity of a business? Again, a repeated question from the previous one. The best indicator of liquidity, well, these two are not liquidity ratios. Well, D is related to liquidity, so working capital is current assets minus current liabilities, but it doesn't really indicate, it's not the best indicator for liquidity because it does not really take any ratios into account. Current ratio and quick ratio, they are liquidity ratios, and the better one here, the best indicator of liquidity, like more reliable, I would say, is B, because A includes inventory. What if there's tons of inventory and you calculate current ratio that comes out to be really good, but then when you subtract the inventory, your situation is pretty bad. Why do we subtract inventory? Because it's 2 steps away from being cash, so it's not the most liquid asset we have. Number 31, again repeated. A business provided the following information about its gross margin. What could explain the changes in gross margin? Option B is totally wrong because expenses come after the gross profit, so they're not even associated with gross margin. Cost of sales is decreasing. If cost of sales are decreasing, our margin should become better, not worse. Quantity of goods sold is decreasing. Quantity does not affect the margin and markup. I mean, the margin basically in this context. Quantity does not affect the margin. If you're selling one product at a 20% profit, we can sell 1,000,000 products at a 20% profit. That doesn't change the margin itself. When the price changes, that's going to affect the margin. Right? Number 32, Sam and Rob each own a trading business. The income of each business is solely from the sale of goods. They're trading business purely. They provide the following information for the year ended 30th June 2020. Return on capital employed, gross margin, profit margin. So it seems like Rob has a better gross margin, but Sam has a better profit margin. Sam managed his expenses better. Current ratio. Okay, let's see what they wanted from us. Rob will find it easy to pay his current liabilities. It's the opposite. No way. Rob's expenses are a higher proportion of his sales. That makes sense. You know why? Because his gross margin was pretty fine, but then when expenses came into consideration, he went lower. You see, he went lower than Sam. He's lower than Sam. While he was better at managing the cost of sales, he was good there. But then when expenses came into equation, he messed up, Rob. So this looks good to me. Sam is not employing his capital effectively. Well, let's see. Sam return on capital. It's better than Rob, so why not? He's applying it effectively. Sam's goods are sold at a higher price. That would mean that probably Sam would have a better gross margin. Although you have to take cost into consideration. What about the cost? If he's selling at a higher price, is he really increasing the cost by the same amount, or maybe more? So cost is also part of the consideration. Anyway, this is also wrong based on this current data. Done. Number 33. Why would the owner of a business want to see his financial statements at the end of the year? To assess the performance and progress of the business. Looks like a reasonable reason to check your financial statements. To determine the market value of non-current assets. To make, not really. Why would you don't look at your profit and the rest of the data to check what your assets are worth? Like, that's not the goal. To make informed decisions for the following years. That is a reasonable option. But if you have two options only from these three, these are the most obvious ones. Two is, maybe some random owner wants to do that, but that's not a general or a normal thing to do. To check your financial statements to see what your non-current assets are worth. That's a time, it's not worth your time. Why would you do that? 34. Charlie is a car dealer. Joe once wanted a new car and went to Charlie's car showroom. On Monday, Joe took a car for a test drive and decided to buy it. That's a unique type of a question I'm seeing here. On Tuesday, Joe arranged to pay for the car by check. On Monday, he drove the car, decided to buy, and paid by check on Tuesday. On Wednesday, Joe collected the car and received an invoice. Okay. On Thursday, Joe's check was cleared by the bank. On which day Charlie was able to account for profit on sale? Interesting question. Unique type of a question. The answer should be the time when the goods were transferred, right? And the invoice was issued. So Wednesday should be the right answer because that's when they decide to buy, it's not a sale yet. When they arrange for the payment, that's still not even if they paid it, it's still not a complete sale. But when the goods are delivered, they're transferred from the supplier to the customer's warehouse or premises, that's when a sale is counted. Okay, C is the answer. 35. Which accounting objective requires that financial statement? Sorry. Which accounting objective requires that financial information is provided in time for a decision to be made? In time. When we talk about time relevance, right? The word that comes to your mind should be relevant. If something is provided for the last 5 years, like let's say we're making a decision about a certain thing, and if you bring up some event which happened 5 years ago and it's not really related to this time period, so you say 5 years ago there was this new government policy, it's not relevant. Talk about what's happening these days. That is more relevant to us, right? So if information is about the current times, it's relevant. If it's about 5 years ago, 10 years ago, it's irrelevant. That's one way to think about it. Okay. Yeah, that's all. So good luck with your exams, everybody. Have a nice day. Goodbye. Share this with your friends. If you found it helpful, subscribe. You'll get more videos in the future, hopefully. Goodbye.